And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. There is a wave of single stock ETFs descending on the marketplace. These aren't your grandmother's ETFs. Oh, no. Remember the old ones? They invest in passive indexes like the S&P 500. Not these. These single stock ETFs allow investors to go both leverage long and to bet short against individual stocks. Currently, single stock ETFs exist for Tesla, Apple, Coinbase, Nike, Pfizer, PayPal, NVIDIA. But this is all new, folks. Tesla, in particular, has attracted a lot of interest. There's 5 single-stock Tesla ETFs, 5 of them. 4 of them launched just in the last week. We'll talk now with 2 men who launched single-stock ETFs last week. Will Ryan, CEO of Granite Shares. Dave Montes, the managing director and head of product and direction. He's joining us. Also joining us, Reggie Brown, principal at GTS, one of the great legends in the ETF business, an old friend of mine. He's here to share his insights as well. Dave, I'm going to start with you. You launched these 4 single stock ETFs last week. You had 2 for Apple, 2 for Tesla. This Tesla Daily Bull ETF of yours, this gets investors 1.5 times Tesla's daily return. It's doing well. It's got some volume. How would you describe the trading action overall? And tell us who you're targeting this product to, considering, of course, it resets every day.
Yeah, that's correct. We've been encouraged by the early success, particularly of TSLL, as the ETF industry continues to innovate and shows the resiliency of the actual vehicle itself. These are tools similar to other leveraged and inverse ETFs that are really intended to be used as a tactical trading vehicle. And so by that, I mean specifically someone who has the ability and interest to monitor their positions on a daily basis, to make that buy, sell, or hold decision daily. Because these funds do have leverage embedded in them, particularly in the case of our bull fund on Tesla and Apple, 1.5 times the daily exposure. And then the inverse of that in the case of the bear funds that we're discussing today. So these funds tend to have, they're going to have a higher risk profile because they have an individual security, and they're really intended to be used by traders. But again, we have shown that the leverage and inverse ETFs on indices have been useful tools for traders, and these actually are a further step in that direction for folks who are interested in the convenience of an ETF and the benefits that the ETF structure can bring to allow them to amplify exposures.
You know, Will, I just want to turn to you. You launched several new products. You launched an Apple ETF last week. You launched Coinbase, Tesla. We've seen these leverage and inverse ETFs. They've been around for a long time, but they've been around for index products like the triple Qs. And I'm just curious, all of a sudden, single stock ETFs have appeared. You know, why now? What happened? What magic was in the air for them to be able to launch now in such a big way?
There was a regulatory rule change in the last couple of years that have allowed for this to happen. And it's really just a natural evolution in terms of the market, because as you said, we've had leveraged products on broad indices such as the Qs, S&P, et cetera. We've had leveraged ETFs on commodities, which have been very popular, single underlying commodities as well. And so now single stocks are the next sort of generation in that category, so allowing people to take either leveraged or short positions on popular companies.
Yeah. You know, Reggie, SEC Chair Gary Gensler, who I've talked to many times, has expressed concern about leverage and inverse ETFs and these other, what he calls them, complex products, which is a sort of an overarching category he's defined. He had a speech in May. He said these funds can present unique and potentially significant risks to investors across market sectors. Obviously, these products are complex. It is difficult for investors to get their head around the concept of the daily reset. But how much protection do you think investors need from these products?
Well, look, I think that's a good question. As Will said, and these ETFs are now trading tools, not investment tools, and understanding how best to utilize them is paramount. And from the perspective of leverage and inverse ETFs, they've been around for a number of years. I believe the community now understands them well. And the risk to the marketplace is really just the retail investors understand how best to use them. There are some proposals on the table to limit the exposure to the retail community of complex ETFs. I think that's a giant mistake to limit the access to the financial market systems, and contrary to what's great about the U.S. system. So with the innovation that is occurring in the leveraged ETFs, particularly in single stocks, by the way, this is not a new idea. It was first proposed in 2009 when there were low-price corporate equities like Citigroup that were trading in the teens, and certain institutional investors could not hold low-price securities. And so it serves a purpose. I think that this type of ETF has the ability to have 1,000 different corporate equities inside them and bring innovation to the marketplace. And this is a good thing. I think investor education and some protections is warranted, but not limiting the access to the marketplace.
Well, let me just pick up on what Reggie was saying, Will, or Dave, either one of you. Do we need to put these products in some separate classification? This has been talked about before, because these are essentially day trading tools, right? Even you guys would admit that, right? So should we change, for example, the sales practices of broker-dealers? Should leverage and inverse products be in some separate category? Will, Dave?
Well,
Dave? Will?
They should, I mean, they're under the rules currently, I mean, they're publicly traded ETFs. And so if a publicly traded ETF, all ETFs are the same in terms of you being able to buy them. Now, what's happened is over the course of time, as Reggie said, I mean, these products have been around for a long time. You know, brokers, which are the access point at the end of the day between the investor and the ETF, have implemented their own rules in order to make sure that these are suitable for the customer base. So typically, if you go buy one of these products or try and buy one of these products for your broker, there is a flag, some sort of suitability measure that you have to meet before being able to buy them. And that's perfectly logical.
Yeah. Dave, do you want to weigh in on this?
Yeah, I would agree with that. To Will's point, there is that there's rules that have been put in place by broker dealers to make it clear that these tools are intended to be used as trading vehicles. So you need to have generally an aggressive trading profile and things of that nature. But as opposed to limiting access, I believe and we believe that we need to promote education and the utility of how these products can be used. Again, these are not long-term investment vehicles. The ETF wrapper also has many, many products that are extremely low cost that can be used to meet those needs. But also, there may be a need, particularly in heightened times of volatility, for those who are interested and those who understand the inherent risk to express viewpoints and to amplify their exposure on a daily basis and on a short-term basis, who want to make that view. Again, if you're bullish on Tesla over the long run, this is not the product for you. You should buy the single stock or use other tools to do so. But if you're bullish on Tesla on a short-term basis, this product, TSLL, for example, can be beneficial.
I want to just get back to why now. And Reggie, feel free to weigh in. But I can't help but notice, I watch ETF flows, I could not help but notice the volumes in leverage and inverse ETFs, particularly around high beta stuff like the triple Qs, went through the roof during COVID. And actually, it's remained fairly high. If you look at the ETF trading list, Reggie, you're the master at this every day. Amongst the highest volume is those leverage and inverse triple Qs that are out there, even on a dollar volume basis, not just a share volume basis. And I can't help but think that the ETF community is sitting around noticing this, saying, oh, there is a demand for leverage and inverse. And the younger community has grown up around using options. They're a little more sophisticated. And we're in the ETF business. Our business is providing product to people. There seems to be a lot of interest in playing leverage products, judged by what we're doing. So am I crazy? The answer to the question is why now is because this is where people have been going recently.
Yeah, and I think it's, again, comes down to, leverage is not a new concept. It's been around for a long time. Sure. But leverage within an ETF makes it accessible in your brokerage account. If you have other forms of leverage, typically that can be clunky to implement, expensive in terms of, the financing rate that you can obtain. And this is definitely something that you have a lot of investors looking for a higher rate of return over a shorter period. And this is what these products, seek to provide.
Yeah. Reggie, am I directionally right on this? I mean, I'm still trying to answer this question, why now? I mean, there was an explosion of interest in leverage and inverse ETFs around, for example, the triple Qs recently. You've seen that. I mean, isn't it reasonable to assume that the ETF community is responding to that interest?
Well, I think there's a couple of things here. One, during COVID, work from home, work from any place, we had more engagement by new retail investors into the marketplace. And as they understood more what the products were available for them to express their views, we saw an explosion in trading from a day trading perspective. Right or wrong, the benchmark serves a certain part of the community. And I believe that there are some investors that like to have amplified returns, and where they can make 4 or 5 or 10% returns a day in their strategies. So there's a segment of the marketplace that demands these products, that want to use these products, and Will and Dave are just filling a need. As far as the number of products that come to the marketplace in the future, competition and through innovation, the prices will come down as far as expense ratio in these products and a number of products on the marketplace from a number of different asset managers launching products. Why now? One, because the regulatory rule set has flattened the playing field for new entrants to come into the marketplace with some speed and efficiency. The commission has an understanding of how to approve these products. On one hand, they're saying you're approved. On another hand, they're saying, please don't trade. So I think the commission just needs to have more comfort into these products and how best they're fitted into the marketplace and how best to use them from a retail perspective. But institutionally, there's institutions who want to use these products. There's big demand for them. And then you look at the high-priced stocks like Tesla, for example, there's a lot of day trading in these corporate equities, and having it into an ETF that provides leverage is just meeting a need. So that's why now, in my opinion.
Yeah. Dave and Will, I'm very curious about the amount of leverage in your products. So, Will, you have your Apple Long ETF, AAPB, is 1.75 times long. You have a Tesla Long ETF, TSL is the symbol, that's 1.25 long. Dave, your Tesla Bull ETF is 1.5 times long. How did you choose these degrees of leverage? I mean, do you negotiate with the SEC on this, or do you pick it out of a hat? I mean, I'm just curious. It's such a strange series of numbers here.
I wouldn't necessarily say it's a negotiation, but we start with 2. So the maximum is 2 times now. So you can't launch something that's more than 2 times leverage. And then during the registration process, there are a set of rules, particularly it's around a new derivative rule that has a value at risk measure. And it's derived from the benchmark, a reference benchmark that you choose. And so in our case, we're obviously choosing a different benchmark than what Dave's firm is choosing for Tesla. And therefore, we have a different leverage factor.
So, Dave, is that the case as well? I mean, when you say what's at risk here, explain that concept. Because why didn't you just have 2 times? And why not? Why 1 1/4 or 1 3? It just kind of it befuddles me a little bit.
Yeah, I appreciate where you're coming from that point of view when you have the same security underlying and in different leverage points from different firms. But to Will's point, yes, it's a balance between the regulatory environment where there's specific rules around what's called a measure of VAR, or value at risk, which is essentially really again a measure of risk. In some ways very complicated, but in other ways straightforward for those who are interested in learning. And in that particular case, when you map it back to a particular benchmark, the 1.5 that we have in the case of Tesla and Apple are the levels that we're comfortable as our firm to comply with those rules and offer a product prudently to the marketplace. So again, these are more sophisticated in how they're created, but at the end of the day, the wrapper is still the ETF structure, and we're complying with all the same rules that any ETF would have on it.